The deadliest mistake you can make in the middle of a crisis is believing the biggest lie Wall Street ever sold you, that cash is safe. They love that lie. It keeps you paralyzed. It keeps you on the sidelines, waiting for the all-clear signal that never comes. Every financial advisor, every bank commercial tells you to sit on your savings, to stay liquid, to feel secure. They use the word security to mask the word loss. Because while you are sitting on that pile of crisp paper, feeling smart, feeling safe, the greatest wealth transfer in modern history is happening right around you, and you are its victim. I'm here to tell you, based on everything Charlie Munger and Warren Buffett have ever taught, based on a century of market history, that your biggest loss is not a stock going down by 50%. Your biggest loss is the money that you hold guaranteed to lose purchasing power month after month, year after year. That is a permanent loss, and it is a loss that you agreed to. That is not safety. That is surrender. We are entering a period right now in this 2025 guide where the old rules have dissolved. The inflation rate, even if it feels lower than the peak, is still corrosive. The average interest rate you get on that safe savings account, it's nowhere near the real inflation number. If the consumer price index tells us inflation is running at 3.8%, and trust me, for the things you actually buy, like groceries and housing, it feels higher, and your bank is paying you 1.5%, you are guaranteed to lose 2.3% of your purchasing power this year. That is not volatility, that is certainty. That is a tax you pay for being passive. You're guaranteed to be poorer next year than you are today. That is the definition of financial failure. The Munger method is not about seeking returns. It's about avoiding permanent catastrophic losses. And a permanent loss of buying power is catastrophic. I've watched smart people who could quote Nietzsche, people who could build skyscrapers, destroy their futures, not by gambling on meme stocks, but by sitting on mountains of cash out of fear. Fear of a recession, fear of a crash, fear of making a mistake. The paradox is that in seeking safety, they guaranteed their own ruin. Buffett taught us that the best investment is one that produces something of value. What does a pile of cash produce? Nothing. It is only valuable as a medium of exchange, and every day the amount of value it can exchange for shrinks. It's oxygen. Yes, you need enough to breathe, but you don't store your wealth in a giant oxygen tank. We need assets that not only survive a recession, but thrive on the fear a recession creates. We need 5 assets that are genuinely safer than cash, assets that transfer wealth to you when everyone else is running for the hills. The fundamental flaw, confusing liquidity with safety. The first idiot mistake is confusing liquidity with safety. Liquidity means you can turn it into cash instantly. Safety means that when you turn it back into cash, you can buy more with it. The two are fundamentally different. Cash is perfectly liquid and perfectly unsafe. A superb, high-quality dividend-paying company is less liquid, but over time, it is infinitely safer. When a recession hits, the fear that grips the market is overwhelming. People sell everything. They sell the bad, the mediocre, and the great. They don't sell because the company failed. They sell because their psychology failed. This is exactly when you must be the patient, rational, almost alien counterparty. Be fearful when others are greedy, and greedy when others are fearful. It's the most cliché quote in finance, and yet nobody does it. They do the exact opposite. Why? Because being greedy when everyone else is fearful feels terrifying. Your entire lizard brain screams at you to conform, to join the panic, to get to the safety of cash. We are going to train that lizard brain. We are going to build a portfolio of assets where the real return, your return after inflation, is almost guaranteed to be positive, even if the nominal price fluctuates. Asset 1. The ultimate flight to safety, long-term treasury bonds. The first asset that is safer than cash during a severe recession is long-term U.S. Treasury bonds. Now, if you only understand the surface level of finance, this sounds idiotic. Bonds go down when interest rates go up, right? Yes. But you're thinking about the ordinary market. We are talking about the recessionary deep dive, the true fear. When a recession hits, when the stock market is imploding, when corporate bonds are defaulting, where does every single large institution, every large pension fund, every sovereign wealth fund in the world run? They run to the only thing that is guaranteed to be repaid by the world's most powerful taxing authority, the United States government. They run to treasuries. It is the flight to safety. Money doesn't disappear. It simply runs from risky assets to risk-free assets. When the S&P 500 fell 50% in 2008, the price of long-term treasuries soared. Why? Because the demand for absolute safety overwhelmed the desire for higher yield. Investors realized that a guaranteed 4% return from a treasury, while not exciting, was infinitely better than a guaranteed 50% loss in a stock portfolio. The safety of the principal became the paramount concern. You use these bonds not for growth, but as ballast. They are the counterweight to your stock portfolio. When your stocks are getting hammered, your long-term treasury position is gaining value, cushioning the blow. This is how you survive the 50% crash without having the psychological meltdown that forces you to sell at the bottom. The treasuries give you the mental capital to hold on to your stocks and, more importantly, the dry powder to buy them when they are cheap. The simple, verifiable truth is that historically, during the first half of every major recessionary stage, core government bonds, meaning U.S. treasuries, have delivered positive returns. Your cash delivered a guaranteed negative real return due to inflation. Your treasuries delivered a positive capital gain due to fear. You profit from the foolishness of the crowd by simply owning the asset that every panicked institution must buy. It's a psychological inevitability. Asset 2, the permanent store of value, physical gold. The second asset, and one that requires the deepest historical perspective, is physical gold. Forget the Bitcoin arguments. Forget the complicated derivatives. I'm talking about the shiny, heavy metal that the ancient Egyptians used and that central banks still hoard. Why is it safer than cash during a recession? Because it is a hedge against the very thing that makes cash unsafe, the unlimited power of governments to print money. Charlie Munger had a nuanced view on gold. He didn't view it as a productive asset. It's just a rock. It pays no dividend. It has no earnings. But he understood its psychological utility. Gold is the ultimate asset of panic and the permanent check against monetary debasement. When people truly lose faith in the dollar, the euro, or the stability of the global financial system, they don't buy more promises. They buy something tangible that has retained its value for 5,000 years. We saw this in the post-COVID period when unprecedented fiscal spending led to inflation. Gold's price surged because investors correctly realized that the massive increase in the money supply devalued every single unit of currency. Your cash was rapidly losing weight, but an ounce of gold remained an ounce of gold, and its price, denominated in those shrinking dollars, went up. In 2025, with national debt levels reaching astronomical, unprecedented highs, the risk of governments choosing to inflate their way out of debt is not just a theory. It's the default economic pathway. Gold is the ultimate insurance policy against that scenario. It is a cynical bet on the irresponsibility of man. Holding a small, disciplined percentage of your wealth in physical gold is not a way to get rich. It is a way to ensure that when the political and financial system experiences a deep, gut-wrenching crisis of confidence, You have an asset that operates outside the banking system and outside the faith in paper money. This is a survivalist mindset. It is the ultimate Munger-esque act of simply avoiding the worst possible outcome. It is protection of principle through the ultimate cynicism. Asset 3, the untouchable moat, high-quality, dividend-paying blue chips. The third asset is the one that separates the tourists from the investors. High-quality, established, dividend-paying blue chip stocks with an undeniable economic moat. Again, this sounds counterintuitive to the fear-stricken gambler who believes stocks are inherently volatile. They are if you buy garbage. But when Buffett buys a stock, he buys a business. He wants a business that he knows will be dominant 10 years from now, regardless of the Fed chair, the president, or the price of oil. What is a moat? It's the competitive advantage that makes the business virtually untouchable. Think of the companies that sell non-discretionary goods and services, utilities, packaged foods, essential pharmaceuticals. When the recession hits, people stop buying new cars, but they don't stop buying toothpaste or their electric bill or necessary medication. These companies have pricing power because what they sell is a necessity. They can pass higher costs directly to the consumer without losing market share.
This is the key to recession safety: sustained, predictable cash flow. While the cash flow of a high-growth tech stock evaporates when advertising budgets freeze, the cash flow of a major consumer staple company remains remarkably stable. This stable cash flow allows them to continue paying and often growing their dividend, even when the market is crashing around them. When the market drops 40%, the true investor sees the chance to buy the same reliable cash-flowing business at a 40% discount. The stock price falls due to the idiot mistake of generalized fear, but the intrinsic value, the ability of that business to churn out profits, has barely changed. Your cash sitting in the bank is losing value. These high-quality stocks are delivering you a steady stream of dividend income, often 3% to 4%, that acts as a perpetual cash infusion, and crucially, reinvests at those dramatically lower prices during the recession. The big money is made not in the buying, but in the waiting and compounding, especially when prices are low. This is the ultimate discipline Munger teaches. Buy something beautiful and sit on it forever. During a recession, that beautiful thing just goes on sale. Asset 4, the bedrock of civilization, absolute necessity, real estate. The fourth asset is not just any piece of land or speculative property. It is absolute necessity, real estate, specifically high-quality multifamily apartment complexes or key logistical infrastructure. Recession-proofing real estate is not about chasing the fastest appreciation. It's about being the last thing people give up. In a deep recession, people lose their jobs, they downsize, but they still have to live somewhere. The demand for housing, particularly multifamily rental units, remains robust. People move out of expensive single-family homes and into smaller, cheaper apartments. The demand shifts, it doesn't vanish. The most resilient real estate assets are those that are absolutely essential to the functioning of society. Think about infrastructure, data centers, transmission lines, cell phone towers, or the essential logistics warehouses near major ports. These businesses operate on long-term inflation-linked contracts. The need for data storage, electricity, and the movement of goods doesn't stop because the S&P 500 is down. These are monopolistic moats in property form. They often provide stable cash flow that is tied to inflation, meaning the rent or the contract price automatically adjusts upwards, directly combating the erosion that kills your cash savings. This is superior to cash because it provides a service that is immune to consumer discretion. You cannot decide not to use the sewer or not to turn on the lights. This strategy requires a long time horizon and a focus on utility. The mistake of the average person is to buy the most glamorous, newest, speculative property based on the recent hype. The smart Munger discipline move is to buy the most boring, essential, and stable cash-flowing property that the local population needs to survive. It is a slow, steady cash compounding machine that acts as a true hard asset hedge when paper assets are melting down. Asset 5, the ultimate non-depreciating asset, yourself. The fifth asset, and the one that Charlie Munger always called the best investment you can ever make, is yourself. Your skills, your knowledge, your ability to adapt. Munger believed that the best thing you could possibly do is become ridiculously good at one thing or reasonably good at several things that complement each other. Why is this safer than cash during a recession? Because your in-demand skills can never be inflated away, they can never be seized by the government, and they cannot be liquidated by panic selling. When the global economy is contracting, the competition for resources and work intensifies. The people who are considered essential, the people who have specialized knowledge that few others possess, are the ones who retain their value, their salary, and their bargaining power. Everyone else becomes a commodity. If you are a great programmer, a brilliant salesperson, a disciplined plumber, or a creative problem solver in a necessary field, your human capital is your greatest hedge. Buffett's favorite investment is a better version of himself. He reads constantly, learns continuously, and applies a multidisciplinary approach to every problem. That process is the single greatest compounding machine in existence. The cost of a great book, an online course, or a specialized certification is trivial compared to the permanent increase in your long-term earnings potential. When the dollar loses 30% of its value, your specialized salary adjusts because your ability to generate economic value remains high. Cash buys less, skill demands more. This is the ultimate investment motivation. You can control this asset entirely. You can wake up every day and choose to make it more valuable. You can choose to learn the financial history that prevents you from making the same stupid mistakes everyone else makes. You can choose to develop the character that allows you to sit with cash patiently, waiting for the pitch, and then act decisively when everyone else is paralyzed. Your ability to think rationally is your ultimate moat, and it is built every day through rigorous self-education. The final wisdom: patience, discipline, and the checklist. We've dissected the 5 assets that stand as a fortress against recessionary fear, but they are useless without the correct mindset. The greatest truth Buffett and Munger gifted us is that the big money is not in the buying and selling, but in the waiting. You now have the checklist to avoid the guaranteed loss of cash. Treasuries, your ballast against stock panic. Gold, your hedge against government irresponsibility. Blue chips, your permanent right to stable cash flow. Real estate, your bedrock of essential human utility. Yourself, your non-depreciating, infinitely compounding asset. The hard part isn't knowing what to buy. The hard part is having the character to buy it when the news is terrifying, and then having the character to hold it when the returns look boring. Your financial future will be determined not by your IQ, but by your temperament. Do you have the discipline to be rational when the whole world is losing its mind? Do you have the strength to look at that inflation number and say, I will not be a victim of guaranteed loss? If you found value in this deep psychological dive, if this checklist helped you redefine what safety truly means, then you know exactly what to do. Like this video to signal to the algorithm that this kind of deep, necessary, long-form wisdom needs to reach more people who are currently paralyzed by fear. And subscribe to this channel. Join the minority that profits from folly rather than participating in it. The market will give you endless opportunities to make stupid mistakes. Your only job is to avoid them. Now go out there and be patient. The pitch will come. You must be ready.